So we are continuing preparation of financial statements of companies. We have already laid the background, and before the break, we saw that there are three financial statements that we'll be covering in this topic. Number one, we said that we'll be preparing statement of profit or loss and other comprehensive income. But I said in exam situation, find out what the question has asked you. If the question asks you statement of profit or loss, it ends with net profit. It ends with profit after tax. It ends with profit for the year. So that is if you have been asked statement of profit or loss. Now, if you've been asked to prepare statement of profit or loss and other comprehensive income, in that case, once you get the profit for the year, you add other comprehensive income, which we have seen there can be a revaluation surplus as other form of comprehensive income. There can be maybe you've disposed an uncurrent asset and it gives you a gain or a loss on disposal of such assets. However, always read the question carefully to find out where those gains and losses are accounted for. Sometimes the question dictates to you where you should account for gains or losses. The second statement that we are going to prepare today is statement of changes in equity. And the last statement is statement of financial position. Now, before the break, we looked at the format and we said that when you are looking at statement of profit or loss, you start with sales, you deduct cost of sales to give you gross profit less distribution cost, less administration costs, and other expenses. But I said sometimes investment income or these other sources of incomes are added to the gross profit. So you have the option of adding them after the gross profit, or you bring them down here. So profit from operations less finance costs, you add any investment income if you have it, to give you profit before tax, and then you less tax. Now all the calculations we were doing, income tax that goes to the income statement as an expense, you come and deduct it here. And remember, when you are deducting it at this point, you account for estimate for the year plus underestimation of the previous year or minus overestimation of the previous year to give you the amount of current tax. And then current tax, you add increase in deferred tax or decrease in deferred tax. If it's an increase in deferred tax, you add it. If it's a decrease in deferred tax, you deduct it to give you the amount of tax that you will account for in the income statement. That's why it's important to cover everything we covered in the morning. All those workings on issue of shares, etc., they'll be affecting the financial statements we are about to prepare. Now, in the format of statement of changes in equity, we had also explained it, and we said that in the columns, you show the ordinary share capital plus all the reserves available in a question. We gave 5 types of reserves. We said there is retained earnings, there is capital redemption reserve, there is a revaluation reserve, there is retained earnings, and there is a general reserve. So you only post in the columns ordinary share capital plus the reserves that you have. Remember, if I did not say share premium is also a reserve. So that is the format of, we had looked at this before we went for the break. Now, finally, there was the format of statement of financial position. So in this case, we said in that order, there is a standard called IAS 1, which gives the format to be followed when preparing financial statements. So according to IAS 1, the format to be followed, you start with non-current assets, followed by current assets to give you total assets, and then you list your equity and liabilities. You start with equity, you go to non-current liabilities, and then finally you go to current liabilities. Now, we also read through a question that we were just about to start. So let me take 1 minute or so to read through the question we looked at. So the question 1 read, the following trial balance has been extracted from the books of Inyanje Limited as at 31st March 2019. So a year that ends on 31st March 2019, that year starts in 1st April 2018. So note that the start of the year is 1st April 2018 and the end of the year is 31st March 2019. And then there is the additional information that was given in that question. Inventory at 31st March 2019 was valued at 250,000. So this is closing inventory because of the date that is given. Building and plant and machinery are depreciated on a straight line basis, assuming no residual value at the following rates. So we've been given 5% on building and plant and machinery, 20%. And then additional number 3, there were no purchases or sales of non-current assets during the year ended 31st March 2019. So there was no non-current asset that was purchased or sold. Point number 4, the depreciation charge, that is depreciation in point number 2. Depreciation charges for the year to 31st March 2019 are to be apportioned on the following formula. So cost of sales will account for 60% of depreciation, distribution 20%, and administrative expenses 20%. Income taxes for the year to 31st March 2019 are estimated to be 135,000. So this estimate of tax for the year, and then we agreed that you check in the trial balance, and you find the amount is on the debit side, we said it's an underestimation. If it's on the credit side, it's an overestimation. Point number 6, the 10% loan notes was issued on 1st April 2017. So the loan was issued maybe, that is 1st April 2018, 2019. So the loan was issued 2 years ago, 2 years before the year end. Point number 7, the year-end provisions for warranty claim has been estimated as 75,000. We said in this case, you compare the warranty in the trial balance in the TB, which is 90,000. You compare it to the year-end is 75,000. So we can conclude in this case, there is a decrease in provision for warranties. We said provision for warranties, warranties are non-current liabilities, unless you are told warranty was for a period less than 1 year. Now, if you find that there is a decrease in provision for warranty, like in this case, it has decreased from 90 to 75, decrease in provision for warranties is treated as an income. It's treated as an income. But you are being told here, warranty costs are charged to administrative expenses. So we will see what to do about that. Now, required is prepare a statement of profit or loss for the year ended 31st and statement of financial position. So I'm not only answering the question because we are in class, we'll prepare all the 3 statements. Number 1, statement of profit or loss. Number 2, statement of changes in equity. And number 3, we'll be preparing statement of financial position. So that is where we had stopped before the break. So let's go to Excel and start solving the question. I hope we are together. So I'm seeing some. I'm just looking at, okay. So let's go to Excel sheet. So we have our Excel sheet presented here. So I'll try to be fast in this question because this is an introductory question, and then we'll go to a past paper question. I just didn't want to go straight to a past paper without laying background through another question, because there are those who are given exemption and financial reporting is their past paper. So for the sake of those who are doing it for the first time and it's their first paper, that's why I'm going and laying this background. So let's have a look at what is given. So in this question, we said that whenever you have any question on financial statements, start by preparing the financial statements themselves. So in our financial statements, in our solution, and this solution for example 1 from the notes. Example 1 from the notes. Now, in example 1 from the notes, okay. I'm just trying to reduce the size so that I have more operating space. Okay, so the first statement that we need to prepare, the name of the company is Inyange Limited. So we have Inyange Limited. Inyange Limited. Statement of profit or loss for the year ended 31st March 2019. So that's our statement period. Now, note that we are working in thousands of dollars. So we are working in thousands of dollars. Okay, so we said in such a statement, always make sure you capture the format right. You check what is your first item. Is it called revenue or sales? We have our sales. So we start sales, and we said after sales, you have you less cost of sales. Cost of sales. After the cost of sales, you have gross profit. Now, after gross profit, always start with the format so that you capture everything. After gross profit, you have the option of adding those other incomes, but let me put them after finance charge. So gross profit, I'll come and less administration expenses, or let me call them costs. I'll come and less distribution costs. I'll come and less if there is any other expenses which do not fall in the category of administration or distribution, other expenses. And then what we get, the result we get is operating profit. Operating profit. So remember that is profit before interest and tax, what is commonly known as PBIT, profit before interest and tax. And then after that, you less any finance costs, less finance costs, and then you can add other forms of income that we have. So if there is any other forms of income, investment income. Remember, there is also an option of including this investment income just after gross profit. The point is, you must account for it before tax. That is the point, the logic. Investment income must be accounted for before tax, And then we have profit before tax. It gives us a result which gives us profit before tax. Profit before tax. I'm seeing attendance is still not very good. We are 79 in class. I expected it to be 100. So let's hope others will join with time. So, okay, let's continue. So that is profit before tax, and then you less income tax. Can somebody communicate in the group that the class has already started? Can somebody communicate to me? The class is already started. So you less profit before tax, you less income tax to give you profit for the year. Profit after tax, you can also call it profit for the year. You can also call it net profit. The point is you must be consistent in how you name it. Now, we have that is format of income statement. Now get me right. If there was other comprehensive income, you account for it here. But in this question, we were not asked to account for other comprehensive income. So if there was other comprehensive income, you come and write there other comprehensive income. And then you come and list them. What are they? Revaluation surplus, revaluation deficit. If it's a deficit, you less. If it's a surplus, you add. And then you get total profit and other comprehensive income. Or you can call it profit for the year and other comprehensive income. But that is not what we were asked in this question. So let's go to the second statement. The second statement will be called copy, okay, I'll paste that, but now I'll call it statement of changes in equity for the year ended, 31st March 2019. So 2019. So we check on what we have. We have called up share capital, that is share capital, and you check any other forms of reserves that we have. Now, in this case, we do not have many reserves. So, but for the sake of knowledge, let me just list as much as possible. So we'll start with, you'll show your share capital. You'll show share premium if there is. Share premium. You will show other forms of reserves. Maybe you will show your retained earnings. You will show your revaluation reserve, etc. Revaluation reserve, and you have your total. Now, and then we have a column for the total. So let me wrap this to make it look presentable. Okay, so that is now, what was the beginning of the year? So beginning of the year, so I can start with balance at the beginning of the year. At beginning of the period of the year, and that date is 1st April 2018. 1st April 2018. That is our beginning of the year. Okay, so share capital, all that we will post as we continue. Okay, so let's now, and then in that case, you account for if there is any issue of shares, you can account for that. We looked at issue of shares in the morning. Issue of shares, you can post what goes to share capital, what goes to share premium. Maybe if there is profit for the year, profit for the year, you account for it. Maybe there is dividends paid. Dividends that have been paid, you also account for it. And then this gives you balance at the end of the year. So balance at the end. Now, what is the end of the year? End of the year is the 31st. 31st, is it March? 31st March 2019. 2019. So that will give you, again, format of statement of changes in equity. Now, when we do more complex questions, we'll have more adjustments to the question. And then finally, you go to the last statement. The last statement, I'll copy that. I'll come and paste. So the last statement is known as statement of financial position. So statement of financial position as at 31st March 2019. So statement of financial position as at 31st March 2019. Now, again, the currency is still dollars. So let me just pick this. I'll pick that. I'll come and post it there. And I'll also come and post it So I'll post it there so that we can work on the statement of financial position. Now, in a statement of financial position, we will start with non-current assets. Now, you list all your possible non-current assets. Remember, we said you start with non-current assets, you go to current assets, you go to equity, you go to non-current liabilities, and finally you go to current liabilities. So let's look at all the possible non-current assets we have in the question. Now, non-current assets are normally arranged in the order of permanence, from the most permanent to the least permanent. And also, you can arrange them according to the standard covered. Maybe there is a standard on IAS 16, you start with PPE. Maybe there is investment property, you go to investment property. Maybe there is intangible assets, you list intangible assets. So you can list them according to the standards. Now, let me go to the trial balance so that I see what I will include. So we can see here there is land and building. There is plant and machinery. There is plant and machinery. Land and building. There is plant and machinery. So land and building, plant and machinery. And maybe all those are property, plant, and equipment. Property, plant. So let me just call them property, plant, and property, because we have already covered IAS 16. Now you know what property, plant, and equipment is. Property, plant, and equipment. Property, plant, and equipment. Remember, that is IAS 16. You don't need to call it IAS 16. I'm just showing that to see how to account for it. Now, we check, was there any investment? I read some note on investment. Where was it? Investments. Where did I read it? I'm just trying to skim through everything. Trade payables, retained earnings, plant and machinery, land, distribution, income tax. So there was no investment. So if there is investments, you include it, but there was no investments in this question. So investments, remember, is IAS. Maybe I've talked of it because I covered it yesterday and shared the recording. So investments, if there is also any intangible assets, you also list it, IAS 38. So let me pick those as some of the few, and then you have the total non-current assets. Total non-current assets. Some of the items I'm listing here, they are not there. It's just that we are in class, that's why I'm listing them. So current assets. Now, current assets, we find out which current assets do we have in the question. Okay, current assets, again, you list them in the order of liquidity, from the least liquid to the most liquid. The least liquid current asset is inventory. And then you go, maybe you check if there is any receivables, trade receivables. You check if there is any prepayments, prepaid expenses. Prepaid expenses, remember, they are current assets. You check if there is any non-current asset, non-current asset held for sale. Held for sale. What do you mean by non-current asset held for sale? These are non-current assets that are to be disposed within a period of 1 year. Non-current assets to be sold within a period of 1 year. Because they are being sold within a period of 1 year, that is why they are put under current assets. Now, this is normally covered under a standard called IFRS 5. You don't need to write the standard. I'm just guiding you on the standard. So you account for non-current assets held for sale, etc. I cannot account for all. Maybe there is cash in hand and at bank. So that gives you a total current assets. The importance of doing this before you start your workings, it enables you, once you are done with any item, you can easily post it. And then also, it enables you not to lose any mark easily. So this gives you total assets. So we will get our total assets from that section. And then next we go to equity and liabilities. Equity and liabilities. We will start with equity. Now, under equity, you transfer everything from the statement of changes in equity. Let me explain. So under equity, you transfer everything from this statement in the order in which they are, and you pick closing balances. You pick these figures. So those are the values you pick. These values here are the ones you pick. So we had share capital, share premium, retained earnings, etc. We had share capital. If there is share premium, there was also retained earnings, revaluation, reserve, etc. Retained earnings, revaluation, reserve, and then we will have our total equity. And then after total equity, we go to non-current liabilities. You go to your non-current liabilities. You find out which non-current liabilities do you have in the question. So you can have the loan notes. I saw some loan notes. What was it called? 10% loan note. So there was the loan note, 10% loan note. So there was 10% loan notes. There was, what else did I see? There was warranty provision. You remember we said warranty provision is an non-current liability. Warranty provision. There was, if there is deferred tax, you include it. Tax. Next, there can be lease obligation, or what we call lease liability. If there is any leases, I'm just accounting for the major standards. Lease obligation or lease liability. If there is, there can be government grants. There is a part that is a liability. I'll explain it when we are covering an example. And then that gives you total okay, you don't need to list total non-current liabilities. You next go to current liabilities. Current liabilities. Now, in current liabilities, we can be having as many current liabilities as possible. There can be trade payables. There can be bank overdraft if there is. There can be accrued finance costs. Accrued finance costs if there is. There can be lease obligations. Now, lease obligations, these ones, they can either, these ones, they can be both current and non-current. So I will explain when we are covering leases. So, and maybe there can be income tax. income tax, and there can be dividends paid or dividends proposed dividends, but I can ignore it for now. I can ignore it for now. And then you can now get total equity and liabilities. Now, I've laid out the format that should be followed when we are preparing this statement. So let me now, that is the format that we will use to prepare those financial statements, the format that we will use to enable us prepare financial statements. And then after that is when now you come to your workings. Now, your workings, working one, we can talk of working one to show the dates, to enable us do work effectively. So the end of the year, end of the year is 31st March 2019. It's important to know the dates because it will affect our future workings. Now, next we have beginning of the year. Is 1st April 2019. Sorry, 2018. 2018. And then now we go to additional informations and we solve them one by one. So let's go to additional informations and we solve them one by one. So let's start with inventory. That one is there is no working there. Point number 2, building and plant and machinery are to be depreciated on a straight line basis, assuming no residual value. So working 2 will be depreciation. So our working 2 will be depreciation. Now, our depreciation in this case is, what are we depreciating? Building 5%, plant and machinery 20%. So we go to the trial balance and check land and building at cost. The cost of land and building is 110. Land is 110, sorry. Land is never depreciated. What we normally depreciate is building. The cost of building was 100,000, but I removed 3 zeros to be 100. So the cost of building, everything is in thousands, remember that. The building rate is 5%. So depreciation of building the depreciation of building is 5%, is at 5%. 5% times the cost of building is 100. So the cost of building is 5% times 100. Remember, we are working in thousands. So I'll just post these as 5% times 100. So that gives us 5. We are working in thousands. Let's not forget that. Workings, all workings are in, sorry. So all workings are in thousands. All workings are in thousands. So that is depreciation of building. So let's go for the next depreciation. Plant and machinery, 20%. Plant and machinery, 25%. So what is cost of plant and machinery? 125. And the depreciation is 20%. So depreciation of plant and machinery. Plant and machinery, we are saying it's 20% depreciation times 125. Of course, okay, let me just remove these zeros here also, not to, so that we are consistent. So that is 100, that is 125. So the depreciation will be 20% times 125. So that will give you 25. So what is the total depreciation for the year? Total depreciation for the year. So our total depreciation for the year is 25 plus 25. So the total depreciation for the year is 30. Now we were given a certain order in which this depreciation will be shared. We were given how the depreciation will be apportioned. What were we told? Additional information. Okay, additional information 3. There were no purchases or sales of non-current assets. So that's good that there is no working there. So the depreciation charges for the year to 31st are to be apportioned as follows. Cost of sales will take 60%, distribution 20%, and administration costs 20%. So I'll have it as a working 3, and I'll call it apportionment of depreciation, or sharing out of depreciation. So we have been told cost of sales accounts for 60%. Of course, times the depreciation is 30. Times 30. So 30, remember, is working 2. Next, we have administration. Administration, we have been told it accounts for 20% times 30. Again, we know that as working 2. And then distribution also accounts for 20%. That is additional information 3. Again, it accounts for working 2. So let me re-show you where I've got them from. Here, the depreciation charges for the year to 31st are to be apportioned as follows. Cost of sales 60%, distribution 20%, and administration 20%. So that is what I've just done there. I've just accounted for those. So this one we were being told it is 30 times 60%. The next one is 30 times 20%. The last one is 30 times 20%. So we have accounted for them. So remember, when we are looking for cost of sales, there will be a depreciation there. So we are working in thousands. Let's not forget. We are working in thousands. So that is working 3. We are done with working 3. So every working earns you some marks. Every working earns you some marks. So next we are being told income tax for the year to 31st March 2019 are estimated as 135. So that leads us to the next working 4. Working 4. That's why we were covering standards in the morning. We were covering, workings in the morning. So there is a working on income tax. Now, in this question, there is nowhere written deferred tax. There is no deferred tax anywhere. I've not seen any deferred tax. So we don't account for deferred tax. So what we look for, what is the estimate of the year? So the estimate of tax for the year, we were told additional information 5. Income tax for the year are estimated as 135. So income tax for the year estimated as 135. And then we said you check in the TB, and check if there is any income tax. You are being told income tax remaining balance from the previous year. Remaining balance from the previous year is 10. So 10, we said if it's on the debit side, it is under. If it is on the credit side, it is over. So it is under because it is 10. So if it is under, you add. You add under estimation of previous year. So under estimation of previous year is 10. So what does this give you? It gives you income tax, but current. current income tax. So our current income tax is 135 plus 10. Now note that if there was deferred tax, you come and add increase in deferred tax if it is an increase, which we don't have. If it is a decrease, you less decrease in deferred tax. Okay, let me just put it as 0. Okay, so decrease in deferred tax. The answer you have is what gives you income tax for the year. Income tax for the year. Income tax for the year, and this is the amount that goes to the income statement. So 145 plus that, let's assume, and then it gives you 145 because there was no deferred tax. This is what goes to income statement, goes to P and L. And this 135 goes to statement of financial position as current liability. Statement of financial position as current liability. So we are done with income tax. We are done with that standard. Now, how do we calculate deferred tax? If there was deferred tax, how did we say you account for it? I hope you remember that. Deferred tax, you will show the carrying amount, tax base, difference, and deferred tax. Remember carrying amount, tax base, difference, and deferred tax. It was not there in this question, so let me leave it out. Let's go to the next working. So the next working is 10% loan notes was issued on 1st April 2017 and is repayable 5 years from that date. So we need to look for working number 5. We need to look for if there is any finance charges, finance costs. So finance costs, you check what was payable. 10% loan note. So there was a 10% loan note. So 10% of 80. 10% of 80. So what is the interest payable? You go to the trial balance and you pick the percentage times the amount of loan in the trial balance, which is 80. So the interest that was payable was 10% times 10% times 80. 8. And then you go to the trial balance. Look at these 10% loan notes. So we were supposed to be paying interest of 10% on the loan of 80. You come here and there is interest paid. You can see interest paid was 5. We were supposed to be paying interest of 8, but we paid interest paid. We paid interest of 5. Therefore, we did not pay 8 minus 5. We did not pay 3. So what we did not pay becomes what is called accrued finance costs. Finance cost or accrued interest. So what was not paid becomes a current liability. What was not paid becomes a current liability. Let's continue. Next, so we are done with working number 6. Working number 7. The year-end provision for warranty has been estimated as 75,000. Year-end provision for warranty. So I'll have working number 6. Provision for warranty. Let's be attentive here. Now, we said warranties are non-current liabilities. You check warranty, which is at the beginning of the year, warranty. And then you check end of the year, warranty. The examiner will always tell you one of them, that one of them is either beginning or end. So if you have been given beginning, you look for the end. Now, here we were told the year end provision for warranty is 75. So I'll come here. At the end is 75. So at the beginning is the one that was provided in the TB, in the trial balance. So warranty provision at the beginning is 90 because you are given at the end in the additional information. So this means at the beginning is 90. So we can conclude there was a decrease in provision. There was a decrease in provision of warranties. Now, decrease in provision is treated as income. So this is 90 minus 75. It gives you a decrease of 15. Now, decrease treated as income. Decrease is income, while if it was an increase, increase is expense. So you have been told where to take it. Where have you been told to account for it? You have been told here, warranty costs are to be charged to administrative expenses. To be charged to administrative expenses. Charged to administrative expenses. So we will take it to administrative expenses. Now, we are done with all additional information. We are done with all additional information. So what was our working one? It was on dates. What is our working two? It is on depreciation. What was our working three? It is on apportionment of depreciation. What is our working four? It is on income tax. Income tax. What is our working five? It is on finance costs. Working six, provision for warranties. Now, there are other workings that we need to know. Working seven, cost of sales. You'll always have it, cost of sales. Because we said you don't list cost of sales, you do workings, it's only the final answer which you take to the income statement. Were we given cost of sales in the question? No, we were not given in the trial balance, so we calculate it. How do we calculate cost of sales? There is the opening stock, or let me call it inventory. And then you add any purchases to give you, and then you less closing stock to give you the cost of sales. But there were other adjustments to the cost of sales. Like, for example, you are told depreciation, 60% of depreciation goes to cost of sales. You are told here, working three. So there is add depreciation 60%. So working three. So you add depreciation working three. So working three, I can just bring it there. Apportionment, the one that goes to cost of sales is 18. And then there was something else I read. I hope I'll recall it. There was something else I read on Cost of sales. I hope it was in this question. Let's see. Were we told to charge cost of sales something else? No, this is administrative. Current. No, so that is only what we have. Okay, so cost of sales. Yes, 60% of 30. Thank you. I've already seen that. 60% of 30, it's already accounted for. It's this 18. 60% of 30 is this 18. So I've already accounted for that. Now let's look for the items you have not accounted for: opening stock, purchases, and closing stock. Opening stock, purchases, and closing stock. So let's look for stock in the TB. Inventory in the TB is 150. 150. Purchases is 470. 150, 470. So 150, and then we have 470. And then we can have less closing stock. Closing stock is additional information 1. Inventory at the end of the year was 250. Inventory at the end of the year was 250. So what is our cost of sales? Cost of sales is equals to 150 plus 470 minus closing stock plus depreciation. So it gives us cost of sales of 388. Now, was there admin expenses? Yes, there was admin expenses. I'm seeing chat. I'm not understanding that code 853. I'm not understanding your question. So we have cost of sales. Next, we go to workings that affect the P&L. Working 7, we have administrative expenses. Administrative expenses. Now, there is the administrative expenses in the TB. Admin or let me just call it in the trial balance. In the trial balance, admin expenses in the trial balance. Admin expenses, did we have them? Admin expenses, it's the first one, 170. First one, 170. Admin expenses in the trial balance is 170. There was depreciation. Add depreciation. Admin expense depreciation. Was it working 3? Working 3, depreciation, 20%. You remember admin expenses, 20% goes to depreciation. There was, here, let's be attentive. I explained some new. Okay, thank you. Thank you. It's working 8. Thank you for the reminder. Working 8. Thank you for that. Now, next, I'm always just reading the chats and I see if there is something you are asking. So next, depreciation is working 3. We have posted it. There was provisions for, please understand me here. You remember provisions for warranty? We were told to charge it to admin expenses. You remember that? Now, if it is an increase, you add it. If it is a decrease, you less. So, because it was a decrease, you less. Less what? Decrease in provision for warranty. If it is a decrease, you less. If it is an increase, you add. It was working 6. If decrease, let me add, answer that. If decrease, which is an income, less from 388, expenses. If increase, which is expenses, add to the expense. So I hope that note will help you remember. So it was a decrease of 15. So this gives you total admin expenses, total administration expenses, total administration expenses. So we have 170 plus 6 minus 15. So total administration expenses are 161. There is still working 9. Which other expense is remaining? Working 9 is distribution. Distribution expenses. Distribution expenses okay, distribution expenses in the trial balance, distribution expenses in the trial balance, how much was it? In the TB, anybody who sees it? Distribution, did we have distribution? Yes, distribution cost in the TB is 240. 240. 240. And add depreciation. There was a depreciation working 3. So depreciation working 3. The one that goes to distribution, it was 6. Now, this gives you total distribution expenses. Total distribution expenses. You must work out everything so that when you are preparing financial statements, it is not complicated. 240 plus 6. So it gives you 246. Are we done? Not yet. There is still one more. Working 10. Non-current assets. Non-current assets. This one, non-current assets. Non-current assets is our working 10. Now, what were the non-current assets that we had? We had land. We had land as a non-current asset. We had building, if I try to recall, building, and there was also plant and machinery. Plant and machinery. Plant and machinery. And then there was total. I'm almost finishing that. Okay. Okay, so I'm almost done with that. We are working in thousands. So here we want to get the carrying amounts of non-current assets. Carrying amounts of non-current assets. So we need to show the cost of the asset, you less accumulated depreciation, accumulated depreciation up to the beginning of the year, and then you less depreciation for the year. Depreciation for the year. Because this accumulated depreciation was up to beginning of the year. Depreciation for the year. And then the answer that you get is what gives you the carrying amount. What Msho called net book value. Net book value. So this is everything that we need to finish the question. So can we quickly go and get these values? Cost of land, cost of building, and cost of plant and machinery. Cost of land, cost of building, and cost of plant and machinery. So cost of land is 110. Cost of building is 100. Cost of plant and machinery, 125. 110, 100, 125. I'm trying to cram. 110, 110, 100. I'm always not a very good crammer. So that is 125. Accumulated depreciation was given. Accumulated depreciation is 48. And there is 48 is for the building. 48 is for building. And there is for the plant and machinery 75. 48 and 75. So 48 and 75. So 48 and there is 75. Remember, land is not depreciated. So depreciation for the year is a certain working. Depreciation for the year, I think it was working 2, if I'm not wrong. Working 2. Depreciation for the year was working 2. How much was it for building? Working 2 depreciation. For building, it was 5. For plant and machinery, it was 25. So we can get the net book value is 110 minus accumulated depreciation brought forward minus depreciation for the year. So it gives you 110 So we have that, and it makes our work there very easy. Now, finally, we have done all workings. We now go and prepare financial statements. Now, in our financial statements, we go and start one by one. If there is a working, we post. So there was sales. Sales had no working. So you pick sales the way it is. Sales is 1,300. You can see the 1,300 there. So I'll post sales 1,300. Cost of sales had a working. So cost of sales had a working. So cost of sales is working what? Working 7. Cost of sales is working 7, 388. So cost of sales working 7. And it's always good to pick the figures. So working 7, 388. You know, the good thing with financial statements, they must always balance. Let me look for admin expenses. Admin expenses was working 9 also. Admin expenses working 9, working 8. Working 8. There is distribution expenses working 9. Working 9. Distribution expenses working 9. There were no other expenses in this question. Now, what is the gross profit? First of all, 1,300 minus 388. It gives you 912. 912 as the gross profit. Let me highlight it in blue. And then there is operating profit, which we need to find next. Operating profit. What is our operating profit? 912 minus 161 minus 246 minus 0. So it gives you 505. 505. finance cost is working. Finance cost, you take the one that is payable, that one, working 5. So that is working 5. Finance cost, working 5. Let me just mention it here. Goes to P and L, and this one goes to statement of financial position as current liability. That is just to help you to revise. I'm almost there. 8, investment income. Did we have any investment income? None. So next we get profit. Profit before tax. Our profit before tax is 505 minus 8 plus 0. So it gives you 497. 497. And then you less income tax. Income tax was which working? Income tax, the one that goes to the P and L, 145. 145 working 4. 145 working 4. This is why this question is normally 30 marks, because of the detailed workings. That's why it's 30 marks. 30 marks is a lot in exams. So your profit for the year is 352. Now this profit for the year, you will transfer it here to the statement of changes in equity. Profit for the year, you transfer it here. So 352, you bring it under statement of changes in equity, profit for the year. Now we go and prepare statement of changes in equity. What is the opening share capital? Did we have share capital? I saw called up share capital. Called up share capital was 200. So I come and post share capital at the beginning of the year is 200. There was no share premium in the question, so I put 0. I don't know if there was retained earnings. Let's see. Retained earnings. Anybody who sees retained earnings? Yes. Retained earnings at the beginning of the year is 270. Retained earnings at the beginning of the year is 270. There was no revaluation. So we can get the total. So total is 470. There was no shares issued. So that is 0, 0. I just gave that. Was there any dividends paid? Dividends paid. Yes, we have dividends paid of 6. You can see dividends. Why do I know it's an expense? Because it's on the debit side. If it was an income, it could have been on the credit side. So 6. Dividends paid is 6. So dividends reduces profits. 6. So I'll write there less so that you know. So what is our total balances? We have 200 plus 0. So that gives you 200. That gives you 0. Here we have 270 plus 352 minus 6. It gives you 616. Here we have 0. The total here we have here you have 6. So what is our total? Our total is 200 plus that is 816. So our total is 816. 816. Now, that is what we will transfer to equity the way it is. The way it is. So equity in the balance sheet, our share capital is 200 from the statement of changes in equity. Our share premium is 0. Our retained earnings is 616. Our revaluation is 0. Our total is 816. You transfer everything the way it is. Don't change even a single item. I'm seeing charts. There is a finance cost in some. Okay. Fred, you should not put it under other expenses. I understand you, finance cost. Did I account for finance cost? Yes, I accounted for finance cost. Now, Fred, you are saying you put it here, it is still okay. But don't call it other expenses if you put it there. You call it less finance costs. Less finance cost. But now these will not be operating profit. If you less finance cost here, this is not operating profit. You will just call profit before tax. You skip this operating profit if you want to put finance cost there. I hope Fred have answered you. Now, next, we go to the balance sheet. We are done with the equity. We are done with the equity. So what we need to look for next is assets. Assets also, there was a working. So what is the working? The working is 182. 182 working 10. 182. It is working number 10. I can write there working number 10. Working number 10, 182. All these others are not there. They will be in another question maybe. So 182 plus 0 plus 0, it gives you 182. Now, we have our total assets there. So our total assets is 182. Now we have current assets. Current assets, we pick closing inventory. Closing inventory was how much? Closing inventory was 250. So our current assets, closing inventory is 250. Trade receivables. Trade receivables, where is it? 728. Trade receivables, 728. Was there any prepaid expenses? No. Was there any non-current assets held for sale? No. Was there any cash at bank? Was there cash? Cash is 9. Cash, you can see, is 9. Cash is 9. So what is our total current assets? Total current assets is that. Total current assets is 987. So when you take non-current assets plus current assets, what you get is total assets. So that is total assets. So total assets. So I can have it there. So total assets is given there. So total assets must be equal to this. It must be equal to total liabilities and equity. So let's go to non-current liabilities. Did we have any non-current liability? There was 10% loan note. It was 80. So 10% loan notes, it was 80. 80. Was there warranty provision at the end? Warranty provision at the end. Warranty provision at the end was 75. Working 6. So 75, it is working 6. You always show the figure at the end. Was there any deferred tax? 0. Was there any lease obligation? 0. Was there any government grant? 0. So what is our total non-current liabilities? Our total non-current liabilities is, or are, 155. 155. And finally, current liabilities. What are our current liabilities? Trade payables is 60. Trade payables. Trade payables is 60. Bank overdraft, we did not have any. Was there any finance cost accrued? Accrued finance costs? 3. Working 5. So that was working 5, 3. Was there any lease obligations? 0. Was there any government grant? 0. Was there any income tax? Yes. Income tax, the amount that goes to the balance sheet. Income tax, where did we solve income tax? Income tax, 135. The amount that goes to the balance sheet. Now, this is now the time we know if we were right or not. So we have our total current liabilities is that 198. Now we take total equity plus total non-current liabilities plus total current liabilities. Were we right? Yes, we were very right. It has balanced. Let me hope yours in exams will also balance. If it balances, you are sure of 30 marks. So that is how we prepare company accounts. Maybe a room for questions, a room for